Morning everybody. Happy Thursday and all of that good stuff. Pound doing exactly what we wanted here. Alright guys, welcome to FX Bootcamp. And remind you the purpose of FX Bootcamp is education. This is not an alert service. I'm not going to make any direct trade recommendations. What I will do is conduct some live fundamental technical analysis. Hopefully put together a trade plan, a decent one or two here. Please bear in mind that trading heavily leveraged risky, so please do not trade your hard-earned money until you have a track record of success using a broker's demo. Blah, 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 blah. Trading heavily leveraged risky. Do not trade until you have a track record of success. Demo account. Past performance does not predict future success. Alright guys, so how are you guys all doing today? There's a couple of orders, agenda here. Whenever I'm being recorded, I always feel a little bit under pressure, like I have to, this is the big moment. This is the indelible thing that's going to be left here for everybody to see. But so I've had a question to look at the Aussie yen. We can do that. From yesterday, we wanted to talk about some money management stuff. That should take about 10 minutes. And then that little trade document I've been distributing, which is almost embarrassingly simple. I should really clean it up and almost make it look professional maybe at some point. We could probably look at that in terms of rules for analysis, rules for trades, etc. And a few questions, and that'll probably take us right to the end of the session, yeah? Alright, so let's start with that Aussie yen, and we can talk about just trading crosses in general and things. Alright? Now, how many of you saw the video today? Were you able to capture some of this pound trade? So, remember how we talked about, remember how I think it was, I want to say our Tuesday webinar, remember how we talked about that if Asia's down, you'll then look for pre-London continuation to the downside, right? Well, look at what happened yesterday on the pound. Right, Asia up. Okay, Asia up. Now that means, alright, so that's Asia up. Now you're saying to yourself, right, where is the next level of resistance, right? And that's where we talked about 160.40 yesterday. You guys remember us talking about that on the pound? Well, I think we printed 160, like 35 or something. Alright, so, the question is, and I'm going to get to that Aussie yen in a minute, and I'm talking now specifically, and this is just going back to the previous discussion we had about time of day, right? So, I'm talking now from Asia into pre-London, moving into London. These are very specifically what you're going to ask yourself, all right? Asian direction here. Okay, which way is that going? Is it up, is it down, etc.? All right? If it is down, you're saying to yourself, where is support and where is resistance? In other words, can it continue? Can it continue? In other words, right, so you're going to go look at your charts and you're going to go, well, has it got room to continue, yes or no? And how are you going to work that out? By looking at your longer term charts, by looking at your pivot points, etc. Okay? Like bust out your technical skills. Like do some things, right? Next thing you're going to say, if it is heading down and it has got enough room, it still has room to the next level of support, well then you need to be saying, right, if it's down, where is resistance to short from? Okay, and if it's up, you're saying, where is support to short from? Yes, it is being recorded. Okay, right, so if you've got enough room to the support, then you're saying, right, where is my resistance to short from? And then you're trying to work out where your resistance is. So the pound, we said to ourselves, right, pound has a shot to go initially to 59.20, and then really an option for it to go to 58.90, you call it 59. All right? So, you look at the pound today and you're like, fine, Asia took us down. Okay, Asia took us down. Right, tick that. Asia down. All right, next thing. Where is our next support level? Okay, it's over here. Why? Because of that trend line and whatever else, okay? Great. So, from where Asia took us down, we have another 50, 60 pips to the support. Fine. Next level of support, plenty of room there. Good. Okay, now, where is resistance to short from? Great. So then we take the fib. Grab the fib, measure it. Alright? Notice that this is a 382. Not only is it the 382, but the confluence area here was his previous swing highs, hesitation zone, buying and selling all day today at that one particular level. Fantastic. Let's put an alarm there. Right? Next thing you're doing. Right? Alarm. Okay. Check that box. Okay. Then after your alarm is set, you wait. You wait. Right. Waiting done. Okay. Price hits alarm. Execute. Execute. Writing with the mouse is easier said than done. Right. Execute. Done. Job done. Okay. Pre-London continuation trade handled. The same exact trade presented itself yesterday, just on the upside. Right. Asia up. Has it got enough room to resistance? Yes. 160.40. Right. Where is support? This is a 50% of this rise here. And it's these previous wick highs and lows through here. Great. Put alarm. Then wait for alarm to be found. Alarm's hit. Execute. Right? Take trade up to target. Take profit. Well, I typically don't put orders where my alarms are, just because a lot of these things are very time sensitive. And I'll also watch for the prevailing correlation at the time. You cannot take a 15-minute change of trend off a 15-minute move fib or swing fib. That ain't gonna happen. No. Right. This is just so easy. Yeah. Right. But this was our trade planning class today. And the other one we set up, I don't want to do all this hindsight trading, but we set up the sort of 106 short tap for exactly the same reasons on the Aussie. And on the Euro, we had this short here in mind, a 140.75 short with a sort of a stop above 90. Same exact thing. All right, anyway. Enough of that stuff. I just wanted to reiterate it because I think conservatively there's a 40, 50 pip trade on a pair or two for you 3 or 4 times a week, trading nothing but the Asia continuation. I could see you making 120 pips a week based on that one little bit of information. That's 480 pips a month. That's 5,000 pips a year. It's not bad. It's not mega, but it's not bad. All right. Now, Aussie yen. Okay. There's a couple of things that go into trading these crosses, all right? And we should talk about these. You've got to remember something about trading a cross. Okay? Is that the actual cross is a figment of your imagination. All right? You're actually seeing things. I see dead crosses. Right? But here's what I mean. Okay, everything in the Forex market is a derivative of the USD, is it not? So if I grab this here calculator, if I give you this calculator, thank you. Here, have this Windows calculator. It's my gift to you. Yeah. All right. Okay. So now, can somebody give me the price of the USD yen right now? 77.36. 77.36. Right? 77.36. Multiplied by the price of the Aussie dollar right now. 1.0594. 1.0594. 1.594 equals. What price is that roughly now? I'll take Aussie yen price for 200, please, Alex. Yes. So the Aussie yen doesn't actually exist. Okay, let's do another one. Let's do another one, you and I. Okay? Take the price of the pound dollar right now. Pound dollar is 159.27, 159.28, 1.5928 multiplied by the price of the yen, 77.35, 77.35. Right, what is the price of your pound yen right now? Right around 123.20, give or take, for spread and some things, and just volatility. Now, why am I bringing this up? Like, why is this important? You know, why is that even? It all depends on the dollar. Right. It's all dollar dependent, ultimately. Okay? Judd's like, well, it's a cool trick, and I can probably show my friends at parties, but it really doesn't serve me anything. Okay? Well, here's the thing, yes, is that they're actually not really on their own. Okay? So you've got to, if you're going to trade the Aussie yen, you've got to have a fair idea as to what the Aussie dollar is going to do and the USD yen itself. Now here's the part that boggles my brain. Okay? Here's the part that boggles my brain. If crosses are simply crosses and just derivatives of USD pairs, how do they respect technical levels? How do they trade as their own entities? And the answer to that is, I have no idea whatsoever, but I don't care. It's a self-fulfilling prophecy, right? But anyway, I'm African educated, and, you know, at some point, my brain switches off to these sorts of things. Alright, it's just genetic at that point. But, okay. So, the reason why I'm bringing this up is, if you take a look at the yens right now in general, okay, here's a couple of yen, here's just a gambit of yen trades. Alright, I'll wait for HotCom to catch up. There we go. Right, now, I trade the crosses all the time. But I like to trade the crosses when you've got positive correlation between the base currency and the quote currency. Good relative strength. That's when the crosses become good. And frankly, if the dollar is moving, I've got no interest in trading the crosses. None whatsoever. It's just more complication and more moving parts to my trading I don't need. Remember the goal. The goal is to be a defeatist. The goal is to make 50, 60 pips, easy pips a day. Easy money. Right? 50, 60 easy pips a day. So whatever's relatively strong versus whatever is relatively weak, just do that. Alright, and obviously I'm being a little bit facetious with that, but I think you know what I'm saying. Alright, so here's our problem with the yens right now. These are 4-hour yen charts. Here's the USD yen. Okay, this looks like a magnificent move, but really it's in a 100 pip range. The euro yen is down on the weak euro. This Kiwi yen has gone all the way down, come all the way up, and is kind of just sort of hanging out in the middle. This Aussie yen has gone nicely up on the 4 hour, sort of jogging up, so it looks like it's stepping up. Alright? And if you take a look at the pound yen, it's in a steady down move here, and, you know, basically looking for this to sell it. So, you've got the Aussie yen saying up, you've got the US yen saying sideways, you've got the euro yen saying sideways to down, and you've got the Kiwi yen saying sideways. So really, is the yen actually a major factor in the yen crosses right now? Not really. Not really. Okay? It's not. Boyke, I prefer not to because just because a lot of times the correlation is going to change, the relative strength could change, any number of new pieces of information could enter the market. An alarm for me is just a level to which I'm thinking about trading at or looking to trade. Yeah, I mean you could use limit orders if you're so inclined, if you trust your analysis to that extent. Sure. All right. So here's another little piece of the pie. Okay, here's an Aussie dollar 2 hour. And if I throw the USD yen on top of this, Solomon, crosses are any like Euro CAD, they're combinations of different USD pairs. Like the Euro USD is not a cross, but the Euro CAD is, because it's basically the Euro USD times the USD CAD. Had an interesting discussion in class today about going live, when is the right time to go live, and how to approach it. Maybe if we have time, we can talk about that. Okay, so here is the USD yen here's the USD yen overlapping the Aussie dollar. Now, why are those two important? Because they're the two currencies that make up the Aussie yen, and I'm cutting to the chase in a minute. All right, but we'll go back to candles. I just think it's easier. Okay, the reason why I'm bringing this up is for a cross to move in a fluid manner, what do we need to see happen? Think about it. For a cross to move in a fluid manner, what do we need to see happen? You need to actually see positive correlation. You need to see positive correlation between the base currency and the quote currency. Yes. Or at least the yen has to be heading sideways, or the base currency has to be heading sideways. Then you're going to get a nice move out the cross. Okay? So now look at this. We're getting fleeting moments of positive correlation. Okay, look here. Negative correlation. Negative. 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 Okay, positive correlation. Right, back to negative. I'll wait for HotCom to catch up here. Okay, right, back to negative correlation. Negative correlation. Negative. Negative. Oh, okay, here we're momentarily positive. Great, we pretty had a nice trading opportunity. Right, oh no, now we're going back to negative. Okay, and here, great, positive correlation, positive correlation, positive correlation, positive correlation. Here, almost positive correlation again. And now we've gone back to sort of mixed. Okay, so my question is the Aussie yen the best pair we're probably concentrating on right now? Probably not, guys. Probably not. You know, if you're looking at an Aussie yen right now, you're really probably only looking for Aussie exposure. Okay? Now, this coming from a guy who in the last presidential election went to the booth and wrote in on the ballot, Aussie yen for president. So, I mean, you're talking to a guy that really likes himself some Aussie yen. Right. Okay? Yeah. Alright, but here we go. Okay, daily chart. What would we say our prevailing trend is right now? on this daily chart? Prevailing trend. Well, I think, strictly speaking, we're making higher lows and higher highs. But ultimately what it looks like to me a little bit is a little bit of sort of a continuation trap here. So it looks to me like we're wanting to do a little bit of something like this. And then it'll probably try and head up again. Okay, so this almost looks like a little flag here, doesn't it? To the downside. Alright. But it's messy. Okay, it's messy. I don't think we have a fantastic directional trade going on. And we saw that reflected pound good dog. And we saw that reflected in our little bit of correlation analysis that we just did on the previous screen. Alright, so the daily chart not really telling us a lot. If anything, we can probably take a horizontal line here and say, look, 83 has been monumentally important. Well, we're going to try to figure it out. I mean, it all just depends what you're looking for in terms of a trade. If you're looking for a spot trade, I'm sure we can find a spot trade. If you're looking for a swing trade, I'm sure we can find the swing trade. I think if you're looking for a trade with meaningful pretensions, you're gonna look for a little short in here that you're trying to take down to 80 cents. Just based on the daily resistance. Alright, and I would work out how to execute on that kind of trade at the moment. But I guess what I'm saying is, what I'm really trying to do here is I'm really actually trying to talk you out of trading the Aussie yen at the moment. But because you asked for it, we're gonna apply ourselves here a little bit. And the Aussie dollar is very similar. I'll give you the 2-minute rundown on that in a sec. And then I want to get onto our money management deal. So, what I'm actually when I look at this 4-hour, it makes me think, well, something like this. In other words, higher low gives us a higher high, probably up to around 83, failure there, jogs down to 80 cents, resurrects the trend and continues up. So yes, this looks long for about 100 pips, which disagrees with the Aussie dollar a little bit for me, but I could see the yen making up the difference. Not really. I mean, I paid like 3 pips on the Aussie yen. Yeah, 3.5 pips on this GFT. When I started trading Forex, I used to pay 23 to 25 on the pound Swiss. It's now like 4. I believe so, yes. Okay. Now if you're going to trade like, right. So I mean, it's like, guys, I don't even have a CAD chart up, honestly. I don't trade a whole lot of loony bin. Right, so what I would be looking for is a little something like this. Given the fact that we're at the top, so I'd expect a little dead cat bounce on this Aussie yen. So I'd look for a trade that looks like this. Lower high, down to around 81.50, jog it up to around 82, 80, 83, and then look at the short side. That's my 2 pips on that. What time my 4-hour bar opened? It opened an hour and a half ago. Okay, right. So, now I would like to talk about, the quick crash course on this Aussie dollar, since that was a question. I really think it's in a pickle now, guys. I really think the Aussie dollar is needing a breakout, because what's effectively happened, let me show you this, show you on the daily. Okay, this here is a 618 to this drop in the weekly central pivot. Excellent Asia short, but as no-brainer as it gets. Yeah, I'll show you in the 4 hour. Right, Asia opens up today on the Aussie dollar at a 618 to the drop and a weekly central pivot overlap. Do you really think they're going to buy it there? This is freaking perfect short. Alright, so down she comes. Now, you grab the fib of the rise, and you're like, well, hang on a minute, it's coming off for 50%. So I'm coming off at 618, and I'm making a higher low of the rise after making a double bottom. So who do I believe? Are we doing this? Or are we doing this? Blue track or black track? Have no idea. Have absolutely no idea. Okay, I sold this today, and I sold it again at 106, and I've just got popped on the reload. Okay, so now what we need to do is we need to get a little more zoomed in and let price tell us which way it wants to go. So how are we going to do that? Grab an hourly. Okay, and we set ourselves right. Grab the little fib of this drop, and we say, okay, cool. As long as we're below our red zone here, we're going to remain bearish. So maybe if we get a little lower high or change a trend around 106, 106.15 or, a lower high, you really couldn't wait for a change of trend. But a little lower high, and yeah, possibly a short. And if we break that, you're probably heading up. And that's going to tell you that these guys have won out. So at the moment, I really think that you don't do anything on the Aussie dollar in this space. I think you just leave it. You leave it between sort of 106, 106.10, and 105.75, and you let price work it out from there. Okay, and that's where I think we're at on the Aussie. Sometimes I like to look at the Aussie, I like to look at the hourly for continuation trades more than anything. But I like the hourly just for our Forex tester, benefit of our Forex tester. We can skip the hourly and be fine without it. Alright? So, I like to handle my trades. I like to manage my trades fairly simply. Alright, so my biggest error as a trader was that I was right on a lot of stuff analytically. However, I would find a way to botch the trade. In other words, I would always find a way to lose money even if I was right. In other words, I would never give it the right stop. My stop would either be too tight or rather, when it wasn't too tight, then I would, inevitably I picked the wrong side of it, right? So I don't trade the 3-minute chart, no. So in other words, I would have a stop too tight initially, and then it would come and knock me out and go in my direction, or I would give it too much room, and then it would hand me a catastrophic sort of stop, and I would have to go and sniffle in the corner. Sort of crawl up into the fetal position and just kind of rock in the corner. Okay? So, after doing this and 2 trading accounts later, it sort of dawned on me that maybe something has to change. That maybe I have to come up with something different to make work, alright? Now, there's 2 types of people out there. There's analysts and then there's traders. Okay, analysts make, right, Crimea pancreas? Exactly. Analysts make 80 grand a year. Traders make 80 million a year. Alright? So, I truly believe that the difference between an analyst and a trader is somebody who can make analysis into money. Okay, make analysis into money. Alright, so what does that take? Alright, obviously a sound psychology, patience, discipline, alright, all the stereotypical stuff. Alright, not to be understated, but a little bit of luck and some family jewels, some attachments. It doesn't hurt. Right, so, right, so the ability to trade your plan. Okay, now the other thing is you need to have sound money management and a set of rules for how you manage trades. Okay, because an emotional approach to management often is worse than an emotional reaction to entry. Okay? So, what I mean by that is this. I manage my trades in a couple of ways. Because I'm a fib guy, alright, I'll have a catastrophic stop and then a manual exit stop. In other words, a discretionary exit point. I would not advise that if you are newer to trading or a novice. Okay, I would just advise you to have a stop and get stopped out. Because if you're sticking your hands in the cookie jar, you're gonna hurt yourself more than benefit yourself. Alright, because you just simply, and don't take this as a condescending thing to say, but as a newer trader, you simply don't have the experience to know when to pull the plug on a bad trade. Alright? But basically for me, I will exit for loss if I have a 15-minute change of trend against me and a break of the support or resistance I'm trying to short off of. Okay? But, let's talk about the pound since this was the trade of the day. Alright, so Asia's down, blah, 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 blah. Line up the fib. Okay, here we are. Alright, and this is why I like to trade with the trend almost 100% of the time, because you can define the risk. Alright, so anyway, our red zone here on this trade is this area. Okay? Yes, I do. I'll never trade a breakout, always trade or support or resistance, always. Yeah, and I never speculate. Meaning that I never try to guess. If I don't have a good idea as to the direction, I simply won't trade. It roots back to that trying to make 50, 60 pips a day thing. It's like, well, if I'm going to watch 2,000 pips go in front of me, why wouldn't I just wait for like the 50 obvious ones and just pick on that repetitively? Okay, so a trade like this, right? Red zone. Stop loss up here. Okay, so that's my catastrophic stop. Alright, now, if price breaks, you can see the wick lows here and some other stuff. Okay, if price printed or closed the candle above here, that would get me out of the trade. Why? Why? Because it's breaking resistance. Okay, however, as long as we're below that, I stay in the trade. So as long as we're below that, I don't care what this thing does. It can turn as many tricks as it wants, providing we're below that red zone, I'm good. Now, this sort of slow to react approach costs me some slightly larger losses. Sometimes, instead of taking a minus 15, like say Chris Stevens will, no, it's not Boyke, but it's part of it, so bear with me. So instead of taking, say, a minus 15, I'll take a minus 25. However, it's also keeping me in some better trades. Because the first 30 pips of a spot trade, the first 30 pips of a spot trade is the sort of very delicate embryonic sort of state of a trade, isn't it? If you cannot manage the first 30 pips, you're done, bro. Because George, a lot of times you're going to come and you're going to wick this area, you're going to close below it, you're going to muck around here, and the trade's still going to work out. And provided you haven't closed above there, you're good. So I cannot tell you countless times it's gone up there, freaked everybody out, and those reacting just jump ship, and I'm like, oh, it's good. We haven't closed above there yet. Oh, awesome. Let's go. So that's why. Because I don't want my stop to be anywhere near where anybody else can grab it. Trading, no, I don't. I simply use technical levels as to where price has to be. No, this is a little scalp spot trade. There was no. I actually think the pound's bullish today, incidentally. So I'm actually looking for this to bottom out here and start to get long at around 160.30. Okay, now alright, so that's how I handle loss. Okay, now the big benefit to trading with the trend in a fib is to define the stop. So if I said to you, right, on this, go ahead and short that. Go ahead and short this. So you're like, cool, I'm going to short that. Great. Now I say to you, where's your stop loss? This is the thing about trying to pick tops and bottoms. And you say, oh, I don't know. Well, how do you know when you're wrong? At what point do you know when you're wrong? Right? So picking tops and bottoms to me is simply, it doesn't make sense to me risk-wise. If your job in Forex is to regulate your risk, then what? Right, so the sky's the limit. I do manage, yes, Dan, I do. I might look at a shorter term chart sometimes for execution, but I'll put it away for management. Alright? Now, contrast that to something like this. You know? Okay, price comes down and you grab this short. Right, now you can say, oh, okay, I think that might be the top. Let me short that. Right, let me put my stop loss. Guess what? You've got defined risk. Do you see how this is very different to trying to shorting a top? Okay, so I encourage you to be very careful about speculating on tops and bottoms. Yes, it defines the risk. Now this isn't only a product of. Please understand that this isn't only this isn't only for the practice of maintaining good risk reward, but this is also psychological. Because there's something nice about going into a trade, nice isn't the right word, but there's something comforting about going into a trade knowing exactly how much you could win or lose, or particularly lose. You know, so if you enter this trade and you're like, wow, I've got to risk 43 pips in this, it's not worth, the quality of that trade's not worth it to me. Okay, you know, and you can use a bit of discretion through that. Yeah, I mean, this is a trendline bounce here, guys. You're at London Open, at support, you're going to change the trend, we're going to wait for a pullback, a higher low, and we're going to long bomb it. Try and take it up to the 85. Okay, now, I'll cover it further if we have time here, but I want to cover this here. I like to break my trades up into thirds. Right, so I like to break my trades up into thirds. Okay, and always have a target in mind. Okay, very, very, very important. Alright, so let's say that you are trying to capture a 100 pip trade, and I saw a question about lot size and risk and things. Alright, so let's say you're trying to capture a 100 pip trade. Alright, I like to think about them in terms of thirds. 1, 2, like that. Okay, so let's say that you are shorting up here. Okay, you're shorting up here with a sell. Make sure I'm showing you the right stuff. I don't know what happened there, but everything bombed. Even on my other computer it bombed. Very strange. Okay, so shorting up here, target down here. Okay, and these are 30% of the trade. Okay, 30, 30, 30. Alright, now, it must be said, and I mentioned it yesterday, that no matter what you do with money management and exit, you are ultimately always going to be wrong in some capacity. Okay? So just accept that mentally. Just accept that psychologically, that you're always going to be wrong. Okay? It's just being less wrong is about the best you can hope for. Alright? Everybody kind of agree with that? Because inevitably, if you take profit, it continues to run. If you don't take profit, it comes back and knocks you out. Yeah. So you can, in hindsight, you can always be like, oh, I should have done this differently. It's always a moving target. I'll never risk more than 0.5% on a trade. I prefer to go in small and add to the winner as opposed to leverage up to begin with. Okay? So, alright. So in this first 30 pips, right, so what I like to do is have at least 2-to-1 risk reward. So when I initially enter the trade, the risk is going to look something like this. Right? For the reward, something like that. Okay, risk reward. Alright? Now, it's never, you're not going to be able to keep the risk and the reward that proportional throughout the trade. It's going to have a bit of a concertina effect. So you're going to have initially minimal risk for lots of reward, and then it's going to sort of balloon out to be about the same risk reward, and then you're going to have to try and bring it back into context. Alright, so what I mean is this. Let's say now you get in this trade, and off she goes. Okay, if I'm looking for 30 and it touches, and it's gone 30% of the way in the trade, so I'm looking for 100 and I'm plus 30, I can lock in break even here. Break even. Okay? Right, so the first third of the trade, I go break even. Right, now, next thing. Cruises into the second third. So now I might be up, say, 40 pips, 45 pips. At this point, I can go plus 10. No more. Okay, so I'm now going to move my stop. I'm now going to move my stop to about here. Alright, so now my risk reward looks like this. Remember, it's unrealized profit now. Okay, so if this is where price is, okay, my new risk reward is going to look something like this. Make sense? And you're basically locked in 10 pips. And this happens in the second 30% of the trade. Alright? Great. Yesterday's fall from 60-40 would have waited? No. A lower high would have been fine. Yeah, it happens, guys. I mean, break even, you got to, this is what I'm saying, it's always a moving target, so you got to take the most generic sort of practice and go with that. Right, so here's the thing, Kruno, you're absolutely right. Okay, so here's the deal, guys. Now price continues. Well, hang on a minute. Now you're up 60 pips out of your 100 pip trade, or 65 pips. Okay? Now you have 65. Now, do you want your risk reward looking like this now? Risk reward? Is that prudent? Is that prudent to have it looking like that? No. No. It's one thing to have it sort of half-half. It's one thing to risk what you're going to get in the reward. But guys, it blows my mind when I see people, well, I was looking for 70 pips, and I was up 58, and now it stopped me out break even. What are you thinking? Well, I was looking for 45, and I was 37 in profit, and it knocked me out for nothing. Like, dude, really? Come on, bro. Come on. Right? So, what you want to do here is you want to get this risk reward back to where it's tolerable. Okay? So when you get into the second or this last 30% of the trade, you now bring your risk reward almost from where you began the trade. So now you take your stop from this plus 10 and you move it aggressively to here. Okay, and the reason why you leave the stop way back there initially is because you need to allow price to come back and fib back to the 618 before continuing. Okay, but now what you're going to do is when you sort of plus 70 out of your 100 is you now want your risk reward to start looking like this again. Okay, now your risk reward's back to where it needs to be. You know what? And if it comes back and knocks you out for 60 and then goes to the target, cram your pancreas. Okay? If it sort of goes to the target some more, and now you aggressively start to move your stop. Now, as soon as it gets closer and closer and closer, you start to risk less and less and less and less as it gets to the target. And then when it gets to the target, you never get out. You just move your stop there, and you're effectively taking profit. And if it falls through the floor, you're good. Okay? Guys, if you... what if it swings, knocks you out? Bear, if it swings back and knocks you out and then goes to your target, such is life. I do not usually take partial profits, no, unless it's at a major turning point. So, for example, I shorted the Aussie today at 106.55, and it came down, and it was basically a 70 pip trade. I took 70% of the profit because I could see it reversing off that level. So in that context, yes. But typically, no. Typically, I like to add to the winners. Whatever the risk reward is. So if I'm trying to get 20, try and trade, I would trail 10. If I'm trying to get 30, I'd probably trail about 12. Okay? And like I said to you before, guys, you know, sometimes this will come back and knock you out and then go to the target. But you know what? You cannot fake a 40 pip trade. You cannot fake a 50 pip trade. If you're up 50 pips and you're looking for, say, 65, get 40 pips out of that thing. Alright? Now, if you are looking for 255 and you are up 83, yeah. Okay, you can't do anything. You're just sitting. You know, like I said to you yesterday, don't, you know, if you are looking for a swing trade, treat it as a swing trade. If you are looking for a spot trade, treat it as a spot trade. Don't try and say, oh, I'm looking for a swing trade. I'm looking for 200 pips, and you're up 60 and you lock in 30. Well, at that point, you haven't taken profit on the spot trade, and you've now stifled the swing trade. So now you're going to get knocked out for 30, and the trade's going to work out, and you might as well have got knocked out for 60. The short at 55 was simply the weekly central pivot and the 618 of the last major swing drop. Now it looks like we're breaking up, so I'd probably look for a higher low and try and long bomb it, frankly. Alright? And that is my money management, guys. So I break everything up. Now the challenge is, it is being recorded, yes. Guys, the challenge is this. I am up 32 pips in a trade where I'm expecting 40. Now what? And it starts to look weird. I'm up 32 and I'm looking for 40 and it's looking weird. That's the challenge. I mean, you really can't do anything. You either got to take full profit or nothing at all. You either got to take full profit or just leave it at break even. You can't, you know, the other cardinal error is, okay, it's hit my target, you let it retrace 20 pips and then you get out. Think about that. Oh look, it's hit my target. Great, now you sit. You're like, oh no, it's retracing. Oh no. Oh no, I just gave back 32 pips. Let me get out. I'll just get out with 18. Oh, you know, make a decision, bro. Okay, at that point you kind of just got to stick with it. Alright? You've screwed the pooch already. Typically not, Boyke. Less moving parts, the better, in my humble opinion. I see benefits to it. Honestly, this, I don't want to encroach on the next speaker's time here. But I've done a lot of robot development over the last little bit. And, we tested 4 years worth of Euro data in a little robot we had. And we applied a scaling tactic to it. And without exaggeration, over about 4 years worth of trades and about 200 trades, the profitability was within about $100 of it, and that's on a standard lot of trade over 4 years. I don't have time to talk about why that is, but maybe I'll explain it tomorrow. Do I scale in? Yeah, if it's a fib trade and I think to myself, right, it could get short at point A, and if it goes higher to point B, you know, that's sort of the next level. Yeah, sometimes I'll put on a trade at A, and if it goes up to B, I'll add to it. But I'll make sure that wherever my stop loss is, the collective trade there does never exceed about 0.5% of my trade account. Does that make sense? But that's really the only application I'll use for scaling into some stuff. Yes. And I'll never reload if the reload is going to cause the entire trade to turn negative. So if I load it up again, and if I reload and a loss on the reload will turn the whole trade negative, I won't take the reload. And that a lot of times is really just a product of protecting my psychology more than anything. I just move it in alignment with how I've broken the trade up into the thirds. Alex, I don't really, some months one might make 3%, other months you might make 23%. It just depends on how fertile the market is. Banny, no. Boyke, the initial stop loss, yes. If you have multiple accounts, yes. Sorry guys, I'm out of time. We're going to have an hour tomorrow to sort of pick up any of the miscellaneous questions. Okay? But thanks for hanging with me, guys. Tomorrow is the final installment of the Daily Planner, regretfully. But I hope you got something out of it. Good luck further today, everybody, and we will chat to you tomorrow, okay? Yeah, thanks. Fantastic attendance. I really appreciate everybody's being here and being respectful, and it's been awesome. So thanks very much.